You trade in dollars, or you don't trade at all. Oil, dollars, shipping, dollars. Sanctions enforced through dollars. The US dollar isn't just a currency, it's the infrastructure of global trade. But China has started quietly building channels that rely less on it. Not with headlines, with credit, payment systems, and Yuan liquidity. China has already extended over 4.3 trillion Yuan in offshore currency swap lines, a financial safety net that allows countries to settle trade without using the dollar. That's not just diversification, that's architecture. So today we're decoding what China is actually building and why even small cracks in dollar dominance can change the incentives of the entire global economy. To understand why China is doing this, we first need to understand what makes the dollar so powerful in the first place. China's bold move to ditch the dollar and what it actually means. For decades, the US dollar has been the silent backbone of globalization. Not because everyone loves America, but because the dollar does three things better than any other currency. It's liquid, it's trusted, it's backed by deep capital markets. China's move isn't emotional, it's strategic, and it's rooted in something much bigger than trade. It's about vulnerability, and let's cover those. Hidden force number one, sanctions are a weapon, and everyone saw it. In 2022, the West froze Russia's foreign reserves. That was the moment. Not because of Russia, but because it proved something terrifying to every major power. Your dollar reserves aren't fully yours. If the US controls the clearing system, if SWIFT can disconnect you, if your treasuries can be frozen, then your reserves are conditional. China watched that carefully. Beijing understood something most headlines missed. The dollar is not neutral. It's a geopolitical weapon. So China asked a dangerous question. What if we build a system that sanctions can't touch? That's where this begins. Hidden force. Number two, credit is more powerful than currency. Most people think currency dominance comes from trade volume. It doesn't. It comes from credit provision. The US dollar dominates because global trade is financed in dollars. Letters of credit, trade insurance, shipping guarantees, commodity clearing, all dollar-based. China is now replicating this model, but in RMB. Instead of just selling goods, China is extending RMB trade credit, offering RMB swap lines, expanding its cross-border interbank payment system, CIPS, financing Belt and Road infrastructure in Yuan. That's the shift. They aren't asking the world to believe in the RMB. They're making it financially convenient. And in economics, convenience beats ideology every time. Hidden force number three, Treasury. Sales are a signal, not a collapse. You've probably heard that China has been reducing its US Treasury holdings. That's true. But here's what matters. This isn't about crashing the dollar. It's about reducing leverage risk. If your strategic rival controls your reserve assets, you are structurally exposed. China has slowly diversified into gold, euro-denominated assets, bilateral currency agreements, commodity-backed trade. It's not dramatic. It's gradual. And that's why it's dangerous. Because slow structural shifts don't make headlines until they do. Hidden force number four, the global south wants optionality. This part rarely gets discussed honestly. Many emerging economies don't love dollar dependency, not because they oppose the US, but because dollar cycles hurt them. When the Federal Reserve hikes rates, their currencies weaken. Their debt becomes more expensive, their imports surge in cost. They are effectively importing US monetary policy. China offers them something psychologically powerful, optionality, not full de-dollarization, just choice. And once countries have alternatives, monopolies weaken. Hidden force number five, supply chains are becoming currency blind. Here's where this gets interesting. If China finances raw materials in RMB, manufacturing in RMB, shipping in RMB, you create an RMB exclusive trade loop. That loop doesn't need dollars at all. This isn't about replacing the dollar globally. It's about carving out parallel lanes. And if enough parallel lanes exist, the main highway loses traffic. Not overnight, but structurally. Let's kill the biggest misunderstanding right now. This is not about the dollar collapsing tomorrow. The dollar still dominates over 50% of global reserves, the majority of commodity trade, the deepest bond markets. China cannot replace that infrastructure overnight, and they don't need to. The real game isn't overthrow, it's erosion. Currency dominance doesn't die in explosions, it dies in percentages. A little less here, a little less there, until the leverage fades. Let's run this forward for China. The benefits are reduced sanction risk, greater monetary autonomy, strategic insulation, increased geopolitical influence. The risks are RMB isn't fully convertible. Capital controls remain. Trust deficit versus dollar system. Domestic financial fragility. If China pushes too fast, they expose weaknesses. If they move too slow, they remain vulnerable. This is a balancing act. For the US, here's where incentives shift. If foreign demand for treasuries weakens, yields rise, borrowing costs increase, fiscal pressure intensifies. Now remember, the US already runs structural deficits. If the dollar's global demand softens even modestly, the cost of empire increases, not collapse, and rising costs changes politics. For global markets, transition periods create volatility, currency realignment, reserve diversification, new clearing systems, hedging costs. You may not notice it immediately, but FX markets will. Bond markets will. Commodity pricing will. Multipolar finance isn't unstable, but the transition to it often is. What this means for you. If dollar demand slowly declines, the dollar could weaken structurally. Imported goods become more expensive. Inflation dynamics shift. If US yields rise, mortgage rates stay elevated. Debt servicing costs increase. Asset valuations compress. If currency blocks form, investment diversification becomes critical. Commodity exposure matters more. Currency risk becomes real again. The dollar system quietly subsidized global stability for decades. If that subsidy fades, everyday volatility increases. For 30 years, many investors ignored currency risk. That era may be ending. Now, what we should be talking about. The real issue isn't will China win? It's this: what happens when no single currency dominates? The dollar era gave us cheap global trade, efficient capital flows, deep liquidity, predictable settlement. A multipolar currency system introduces fragmentation, political risk, pricing, regional blocks, strategic trade alignment. That doesn't mean worse, but it does mean more complex. And complexity creates friction. Friction creates cost, and cost changes behavior. This is about the future architecture of globalization. Not nationalism, not ideology, infrastructure. Hidden force number 6, the liquidity trap nobody mentions. Our last hidden force is one problem. China cannot engineer its way around. Liquidity. The dollar dominates not just because it's used, it dominates because it's trusted in a crisis. When markets panic, capital does not run to convenience. It runs to safety. And right now, the deepest, most liquid, most transparent capital markets in the world are still in the United States. The RMB is growing in trade, but it is not freely convertible. Capital controls still exist. The Chinese bond market is not as open. The legal system is not perceived as neutral. And in global finance, perception is power. This creates a tension. If China wants the RMB to become truly global, it must allow more openness. But more openness means less control. And control is central to China's domestic financial stability. So here's the real balancing act. To rival the dollar, China must liberalize. But to preserve political stability, it must restrict. That contradiction is the invisible ceiling on RMB dominance. And this is why the shift won't be explosive, it will be negotiated, gradual, strategic. Because global reserve currencies aren't just about trade flows, they're about who the world trusts when everything breaks. Let's talk about 3 possible futures. First scenario, slow erosion, most likely. The dollar remains dominant but weaker. RMB grows regionally. The world becomes bipolar financially, no collapse. Just diffusion. Second scenario, accelerated fragmentation. Sanctions escalate. Taiwan tensions rise, commodity trade splits sharply, financial blocks harden, volatility spikes. Third scenario, reconciliation. China liberalizes capital markets. RMB becomes partially convertible. Dollar and RMB coexist in structured equilibrium. Low probability in the near term, but possible long term. The real hidden insight. This isn't about China versus America, it's about incentives. The US has used the dollar as a strategic tool. Rational actors respond to incentives. China is responding, and once a parallel system exists, even partially, the monopoly is never as strong again. That's the hidden economics of this moment. Power shifts slowly until it doesn't. For 50 years, the rule was simple: trade in dollars. Or don't trade. China is testing a different rule: trade with us, on our terms, in our currency. Whether that succeeds or not, the architecture of global finance is evolving. And the most dangerous shifts are the ones that don't look dramatic. They look incremental, until the leverage is gone. Stay smart, stay curious, keep decoding the system, and I'll see you in the next one.